Hello everybody, welcome in. I am not in my usual place today and my back is tossed, so you will not see me live. But anyway, we're going to talk about the Fed minutes and the impact that has on the markets and how I believe it'll impact the markets going forward as well. So a lot of stuff to cover here, and let's just jump in. And the old expression is, of course, don't fight the Fed. Instead, watch the Fed like a hawk. Excuse the pun. For those that don't get that pun, you'll find out in a minute. So as usual, this is not financial advice, and never is. So let's talk about exactly what happened. First of all, the markets, after the FOMC minutes came out, stocks rallied, Bitcoin rallied, utilities rallied as well. Energy were the losers. Dollar and Bitcoin went up. I'll talk about dollar in a minute as well. Gold tanked, oil fell, and the US 10-year Treasury rose a little bit. I'll also talk more about that too. So let's talk about what, just a quick sidebar with the dollar index. I just want to insert here that a strong dollar people think is a good thing. It's actually not, especially for companies that have the majority of their earnings overseas. If the euro has lost 20% of its value and a company gets 60% of its revenue from euros, but it's a US-based company, you can imagine the hurt that that causes. And here's a list of some top companies that bring in a lot of revenue from overseas. One of the ones is Nvidia, which we look at carefully here. So let's talk about exactly what the Fed minute means. Basically, the market rallied a little bit after the Fed moved because they took the 100 basis point hike off the table. That's the reason for the rally. In terms of where we stand right now, this is the CME Fed Watch tool. You can see here the odds of a rate hike in July are high, and they are running at around 75 basis points. But my question is that even possible? Can they do that? And that's kind of, sometimes I'm a little bit low on my theories for Fed hikes. But who knows? I just build models, look at numbers, and maybe the models are wrong, maybe the numbers are wrong, but we'll show a couple as well coming close. Now, what's typically happened after a Fed hike news, or they take something off the table like 100 basis points, the markets don't quite understand it immediately, so they take time in figuring it out. So the next day, markets typically fall, and I believe that could happen tomorrow. So be prepared for that. Now, what's going on? So the Fed minutes, of course, they read hawkish. So if you look at this little chart here, you will see dovish, the dove on the left in blue, and red hawk on the right. Basically, the Fed minutes read hawkish. But it's also important to remember that these minutes were from a meeting on the 14th of June, 2022. So it's nearly 3 weeks old, and a lot has changed in that time frame. So let's dig a little bit deeper and talk about the go-forward plan. Obviously, we had the biggest rate hike since 1994 last month. That was 75 basis points, or 0.75%. And now the Fed is expecting to do another 75 basis points in July. So we'll see where this goes. Now, when you look at the dot plot, this is basically the summary of projections of how the FOMC, Federal Open Market Committee, expects to increase rates through year end. And you see towards December, there'll be peak interest rates and then back down to the normal very low rates by 2024, 2025, and onwards. So again, they know as well as we know that you cannot have high interest rates, especially when a country has such a high debt load. It's mathematics. Again, my opinion, I could be wrong. But a lot of people expect continued rate hikes through the end of the year. 75 basis points soon. And then in September, another 50 or 75, and then November, another 50 or 75, and then in December, more as well. But I do not see that coming. So first of all, let's talk about the meeting. What's happened since the last June meeting? One, we've had non-stop recession chatter everybody is talking about a recession. I've been talking about it for a while. Now, over the last 5 to 7 days, every news channel is talking about a recession. Also, number 2, consumer has been crushed and demand has been destroyed. Everybody is sitting at home. Nobody is spending. Nobody's buying houses. Houses are not selling. Nobody's buying luxury items. If you look at the car companies so far this year, many big companies like Honda, etc., their sales are down 50%. Oil prices are down. They're tanking again today. They fell 10% yesterday, which is kind of staggering. And there is definitely lower inflation expectations. So my forecast, again, not financial advice, but I believe the Fed, despite the fact that CME believes there's a 75% chance of a 75 basis point increase, I believe they might opt for 50 basis points because they have to engineer that soft landing. And I'll prove that with some numbers in a minute too. Now, the other thing as well, they are gunning for 2% inflation, and that target is ridiculous. The Fed has that 2% inflation target in a world where we have technically 14% historic inflation, but the CPI, which is fabricated, says 8%, 8.6%, 8.3%, depending on the actual month. So I think it's time for them to set a more realistic expectation of 5% inflation, long-term average inflation, because they also need this to inflate their way out of debt. And that's the little dirty secret here. Even at 2% inflation, imagine you have $100 in your back pocket and every year somebody takes $2 out or €2 out. That is what they believe should be the normal expectation, but that's impossible in the world in which we live in. Now, the other thing that the officials said in their Fed minutes 3 weeks ago, like I mentioned, they said data showed US GDP product economic growth was expanding in the current quarter. So at least the Fed is very consistent that they have no clue what's going on about inflation, GDP growth, transitory, not transitory, etc. And they also said the job market is still tight. They are clearly clueless because anybody you talk to, any company out there, there is a hiring freeze. They are not hiring people, and in many cases they are firing people, letting people go all across the board in financial services, real estate companies, crypto companies, manufacturing companies like Tesla, you name it. Even AI companies, they're letting people go. The market has radically changed, and obviously the Fed are definitely behind the 8 ball, and that's just 3 weeks ago. And I've been talking about recession for a lot longer than 3 weeks. So how can everybody know more than the Fed? I don't know. I don't understand. And this is proof in point. The Atlanta Fed estimates GDP growth to be minus 2% for the current quarter. And that's it. Basically, it's all but guaranteed. And I discussed this on Saturday's video as well. So next point. Trends happen fast. I always talk about, be on the train because markets move real fast. Well, look at energy. Energy is down more than technology from the 52-week high. So XLE energy is down 27.8% and XLK technology is only down 27%. And that is very, very interesting indeed. Basically, energy companies have shot up faster and they tanked faster. Whatever goes up real quick comes down real quick too. So let's look at the components of inflation real fast. And I put this little eye chart together. Apologies if it is hard to see, but everything you see here is basically the components of the year-over-year inflation, basically comparing May 2022 to May 2021. And you can see very clearly all the big numbers in dark yellow, orange, red. They're all energy commodities, gasoline, fuel oil, energy services, electricity, utility, piped gas services, all up crazy, especially fuel oil, 106.7%. And that's not good. Now, a different visual of how these components look is here. You can see all the big spikes are energy related. Now, there will be some inflation coming down the pike for things like food, which are not fully reflected yet, shelter, salaries, etc. They will all go up, but nothing like the spike we had. So the question is Is peak inflation behind us? Yesterday I discussed it, and I believe so. But remember, the Fed are looking at obviously very old data, so they may not see this yet. Now let's go back to my simple planned hike model with the impact on GDP. Very, very simple, straightforward model. Again, I don't know why people aren't talking about this, but every time that the Fed hikes interest rates, they reduce GDP because the debt servicing increases. So here I've laid out the basis point hikes. We have the US national debt, that's 30.563 trillion. It's gone up 163 billion since I did this a few weeks ago. Okay, that's how fast the debt is growing. US GDP, 23.5 trillion. Federal debt to GDP, 129.56% as of today. And the US interest rate on debt today after the June hike is about, the effective rate is about 2.92% by my calculations. And you can calculate the debt servicing increase based on the hikes we've just done today is about $890 billion. So that eats up about 3.79% of GDP. As they go forward, they're going to eat more. So let's talk about July. This is the expectation from all the experts out there, including the Fed. They're going to do 50 or 75. I just put it in as 50 for simplicity. In July 27th, another 50 in September 21st, another 50 November 2nd, and another 50 December 14th. So if they do those 4 additional hikes, that will pull an extra $1 trillion out of GDP. Remember, GDP is 23 trillion. You're taking 1/23 of it off the table, which is not sustainable. So this is my forecast. And again, I could be wrong, but if I was managing GDP and I didn't want to crash land the economy, which they may still do anyway, I'd do 50 basis points in July, and I might do 25 basis points in September, depending on how fast inflation comes down. But it's coming down of its own accord. It's not coming down because of interest rates. It's coming down for other macroeconomic reasons, in my opinion. And I would not hike in November, and I would not hike in December, because again, if they do keep to their plan, they'll pull $1 trillion off of GDP, because that'll go into debt service increase. And remember, they still have to print money. They're having a tough time issuing debt, selling bonds, etc. And by the way, I created a new graphic. I showed this yesterday. Today, we inverted again. So this is the year-to-date chart of it's the 2-year divided by the 10-year. And you can see we are above the line like we were on April 1st. So this is not a good situation to be in. So if you look at the 2-year interest rate, it's 2.963%. And the 10-year is 2.926%. Again, long-term interest rates are lower than short-term interest rates, which doesn't make sense. It's much harder to predict over much longer periods of time. Therefore, you add a higher typical interest reward for giving guarantee for that level. So again, this is a clear sign, like we had April 1st, that a recession is looming. And finally, we've been waiting, accumulating cash, waiting to deploy, but we still have so many ominous clouds hovering above. We don't know what the Fed is going to do. I started this by saying, don't fight the Fed. It's very, very important to always watch that. But there could be a glimmer of blue in the sky here, and we're just waiting for that Fed pivot to happen, because then risk on happens and then the markets will shoot upwards again. That's what we think, that's what we hope, and we'll see what happens. But again, remember, our future, our destiny is in the hands of people that had no clue that was what was happening 3 weeks ago. So can I guess what action they're going to take? No. Can I say what I would do? Yes. And hopefully smarter minds will prevail and they'll do the right thing. So let's see. Either they will crash land the economy, explode the deficit, crush GDP, and spin us into financial Armageddon and a deep, long recession, or they'll take the foot off the gas, stop hiking rates, and go back to what they've always done. QE to infinity. So anyway, hope you guys like the content. Sorry, my camera is not on today, but you hopefully will see me tomorrow. Thank you everybody for being here, and Thank you to the mods in the chat and everybody else. See you soon.